Fantastic. So welcome to Tax Tuesday. Hopefully you're popping in there. I don't know if I can see whether people are flowing in or not. Zoom is being zoomy today. So if you're looking for Tax Tuesday, you're in the right spot. We're trying to bring tax knowledge to the masses. My name's Toby Mathis.
And I'm Jeff Webb. Sorry, I
And
was distracted by the thing crawling across the screen.
what's crawling over there? Something crawling? Yeah, we're not the best at computers here. So Jeff's trying to show me a thing or two. And Zoom likes to just put things up there. So anyway, let's dive in, right? You're here for taxes, not for lessons on Zoom etiquette. All right, so let's talk about this real quick. If you have questions today, put it in the Q&A. Questions today, put it in the Q&A. That actually rhymes.
Nice.
And we have Dutch, Elliot, Jared, Trisha, Amanda, Patty, Matt. Like we have a bunch of tax attorneys and accountants on who will answer your questions for you. So if you have any year-end stuff, if you just have, boy, this is bugging me, I just wanted to know the answer, throw it in there in the Q&A. If you start asking questions like, hey, my 1040 is this, that, and the other, what's, blah, 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 strategy, this, that, and the other, we're probably going to ask you to become a platinum client or to become a tax client. You could email in questions, general questions, to taxtuesday@andersonadvisors.com. We grab 10 to 15 of those every event, and we go through and we read them and answer them, and then answer all your questions. If you have comments, feel free to put them in chat. In fact, one of the favorite things we like to do here is say, what city and state are you sitting in? And don't say intoxicated in Seattle. What city and state you are in, put it into chat so we know where everybody's sitting. It's always fun to see. So there's Claremont, Florida, Kansas City, Kansas, Odessa, Florida, Osteen, Florida, Fort Collins, Colorado, soaking in Seattle, Springfield, Eastern PA. Ooh, now they're flying by. Heath, Hyattsville, Houston, Wisconsin, California, Massachusetts, What Cheer, Iowa. Didn't know there was a What Cheer. Oh my gosh. Now it's doing weird things up on top. New Jersey, Pompano Beach, Florida. I bet you it's nice. Tulsa, Oklahoma, Maple Lake, Minnesota. I have not seen a Hawaii. Anybody out there in Hawaii? Salt Lake City, Utah? Usually we have like all time zones covered.
Yep.
Do we have any? There's Wichita, South Florida. I'm not seeing any Hawaii. I'm feeling kind of bad now. There's more Colorado, Vancouver, Washington. Hey, Joe. And hey, Joe, NorCal, Northern California, two of them from there. Again, I didn't see any Hawaii White Plains, so I'm kind of sad here. There's Mark Perry. All right, so now we have Hawaii in the house. All right, Seal Beach, California as well. In Bellevue, Washington, if you want to be tax client, please let me know what will be the cost. Hey, Raj, nice. There's some more Hawaii. I always know that we got them on both coasts, so we have to check that out. So anyway, this is supposed to be fast, fun, and educational. We try to get done in an hour, but Jeff is very, very talkative. Talkative Jeff. All right, speaking of talkative, let's go through the questions that we are going to answer. We're not going to answer them yet, but we're going to read them out so you get to see what are the questions. Hopefully one is ringing true with you and you get like, gosh, I really want to hear the answer to that. So you stick around. All of my LLCs are disregarded right now. I'm in the process of setting up one LLC to be taxed as an S or C Corp as management for all my LLCs. What are some of the write-offs by 12/31/23 as a corporation? So we'll go over that. Jeff will probably have something to say. You've been a CPA for what, 30, 40 years?
30 years.
30 years. I'm just estimating high. Can I 1031 exchange, that's 1031, a long-term rental, single-family residence depreciating over 27 and a half years into you got somebody gave you a little, what is that called? Meh.
Oh, yeah.
Somebody gave you a reaction, whatever that's called. Confetti? Is that confetti?
The party, yeah.
It's a party thing. Give Jeff a thumbs up if you think that 30 years is good to be a CPA. I don't know how he's done it. There we go. So you get some thumbs up. They're all down here. I don't know why we have 3 screens and it kind of picks ones to do it. I don't see any crying emojis, so apparently they think that's good. All right. Can I 1031 a long-term rental, single family residential depreciating over 27 and a half years into a short-term Airbnb and then perform cost segregation analysis on the new property? Boy, you picked a good topic. How does this impact depreciation, recapture, and depreciation schedules going forward? moving from straight line into accelerated. The goal here is to apply paper losses against W-2 income. Whew. Good questions again. How do I write off business startup expenses before the business actually starts making any money? LLC cost, education cost, travel expenses for business education, business essentials, phone, office, etc. Good questions thus far.
Mhm.
Elliot always picks these. He's one of our tax attorneys. He's probably on. Yeah, I see Elliot's name. And so we always rate whether he gave us good questions or not. How are you thinking thus far?
Uh, so far so good, but I know he's got some that I have to keep answering no on. So,
All
but go
right.
ahead and give him some. It's a little love.
Elliot, that's you. All right. If we are flipping a home within 6-month period, can we do accelerated depreciation on top of the fixing costs, real estate commissions, closing costs, etc.? Ooh, dealer status question. My husband owns and operates an electrical business. When he finishes his job, he provides a statement due upon receipt. If a client does not pay, is it considered a loss and is it tax deductible? Question mark. Good question. Get that one a lot, actually. Please discuss the pros and cons of borrowing from my life insurance policy to purchase real estate. Is any part of the interest I would pay on this loan tax deductible? Good question. I have a feeling Jeff will answer that because he loves that type of question. How do I offset passive losses other than increasing rents and paying off debt? Do I partner with someone who is generating a lot of passive income? Buy a property that has generated a lot of income for the year? What can I do before the end of the year so I can use it for this year's taxes? Good question again. I'm a licensed contractor working full-time in my 100% owned construction company. I am a salaried employee, so I do not have a punch card to track my work hours. I am a real estate professional for tax, or am I a real estate professional for tax purposes? So we'll dive into that one too. Can I create a 401k for my real estate investment business? Does it cause problems if my salary job provides me with a 401k? Is there an age limit for hiring our kids to work on our family business? We have a 6-year-old and a 13-year-old. Love that question. So if somebody's thinking ahead, like way ahead. You do that for a few years, your kids are gonna be millionaires if you do it right. So we'll show you that way. All right. Already a ton of questions already going into the Q&A. So you guys are already making our folks work. So thanks again to Dutch, Elliot, Jared, Trisha, Amanda, Patty. Probably missing somebody, but there's a bunch of folks. Matthew, he's on there too. Hey, if you like questions and answers and you just want to learn more about real estate tax, asset protection, even investing, and if you want to learn about welding, I had Tyler Sassy on
Really?
talking about how much you make as a welder. It's pretty cool. He's one of our clients. He's a really great guy. Yeah, some of you guys know who Tyler is. He's a rock star. Like he did a really good job. So go to my YouTube channel, subscribe, like all the stuff, or just go watch videos for that matter. And if you're on YouTube watching this right now, make sure, see Tyler's that guy over there in the corner. Why you should learn to weld. I just decided that everybody should learn to weld, but those guys do really, really well. And we need people in the trades. And I'm not
Oh,
saying,
absolutely.
yeah, somebody says, I love to weld. If you like welding, put it in the chat. I like welding, and other people should learn to weld too. So even if it's not your career, it still sounds like fun. I know it's hard work, but you get paid a lot. These guys are making about $100,000 a year. And he has a school. They'll even teach you, like they'll even cover the cost of doing the school. They have ways to do that where you work it off later. It's actually really cool. See, I want to learn. See, all these people, go to my YouTube channel. See, that's my shameless pitch. If you want to learn how to save your money, if you want to learn how to protect your money, keep it away from the lawyers, Snoops, and Uncle Sam, then by all means come to our free real estate tax and asset protection workshop. The virtual workshops are 100% free. They're 1 days. Let's see. Looks like we have some coming up on the 16th, the 21st, and the 27th. And we have a 4-day event coming up this week, actually, like in a couple of days.
Yep.
Here in Vegas, where we're going to have hundreds of people here in Vegas. We're going to be hanging out, going over an infinity day on investing, and then 3 days on tax and asset protection. So if you really like this, it's fun. Somebody says, I taught welding in 1969 in Cleveland, Ohio. You'd like Tyler. He really cool dude. He dropped out of high school at 16. Like I'm learning all this stuff while I'm interviewing him, but you know, ended up building a very successful school, has done really well financially for himself. But what's more important is he's making America a better country, and he's teaching people how to be good workers and teaching them a skill that nobody can take away from. All right, so there's the YouTube stuff. If you want to come to YouTube, Clint has a great channel as well. My partner Clint, Clint and Michael are my partners, but Clint has a really good asset protection YouTube. Michael, we are just trying to get him. So I'd keep trying to push him, like, Michael, have a YouTube channel. But he's good enough to let Clint and I do it. We're weird. We love it. All right, let's do the first question, Jeff. All of my LLCs are disregarded right now, and I'm in the process of setting up one LLC to be taxed as an S or a C Corp as management for all my other LLCs. What are some of the write-offs that I get before 12/31/23?
Well, one thing we need to put out there is you normally can't start writing off stuff that happened before you had your entity. Now, there is the exception for certain startup expenses. You don't have as many to choose from in an S Corp as you would a C Corp.
Mm-hmm.
And there's organizational expenses. So like the cost of setting up the S corporation is an organizational expense. That will be, you'll be able to write that off.
Let's hit some basic real quick.
Okay.
When you see LLC and you hear disregarded and you see LLC taxed as a S or C Corp, I just want to make clear, the IRS doesn't know what an LLC is. They go like this. I don't know what you got. Tell me what you got. Tell me what you got. And then you say, oh, it's just me. That's disregarded. Or, oh, it's a partnership. Or, oh, it's an S Corp. Or, oh, it's a C Corp. You do this on an SS4. And if you do an S Corp, it's a 2553. But you're just letting the IRS know what it is because they don't recognize an LLC. So when I see disregarded LLCs, that tells me somebody is probably doing real estate and they probably want to have it one LLC that is taxed as an S or a C Corp to collect rents and to gather expenses. That's what it's telling me when I see this. You agree?
Yep.
All right. So now we have these LLCs that are doing real estate. You get deductions on your ordinary and necessary business expenses on those.
Yep.
So it's not like you lost out. But now we set up an S or a C Corp before the end of the year. Does it trigger anything special that I get to write off? And the answer is probably not, right? There's $5,000 for startup expenses, $5,000 for organizational expenses that you can grab lickety split and reimburse yourself and write off. But it has to have income.
Yes.
To really get a benefit out of that.
And I'm not sure if you agree with this, but I'm not crazy about having an S Corp as a management company, especially if it's managing real estate. Because then any management fees just create passive losses, most likely, and ordinary income at the same time, which both end up back on your 1040 with an S corporation. So that's why I prefer the C corporation. Like I said earlier, there's actually more deductible items.
What about double taxation? My accountant has a heart attack and immediately starts saying, oh my gosh, you're so dumb. You set up a C Corp. It's double tax. What do you say to those people?
There's so many things you can do. I mean, there's times where dividends are applicable. You can pay a salary out of that S Corp or C corporation so you don't get hit with double taxation.
But let's be real, 80% of C Corps zero out, at least.
Yeah, and thank you. That was the other thing I was going to say is you can make your management fees pretty close to whatever it is you're reimbursing, and the C Corp never makes hardly any money.
And then what Jeff said about C Corps get more deductions. C Corps, assuming you don't have another company that's a C Corp with a bunch of employees, right? You can't, we have discrimination rules, but assuming that this is just you and it's, hey, this is my family and I have a W-2 job or something, I can write off 100% of my medical, dental, vision expenses for myself, my family, anybody who's a dependent of me, including my parents, if they're dependents. I can write off all of their medical. And like we've seen, what, $25,000, $30,000 medical expenses reimbursed out of a C Corp, 100% deductible to the C Corp. You don't have to report it as an individual. It's under an accountable plan. Plus, you can do administrative offices and get another $5,000-$6,000 a year tax-free. Plus, you can do 280A, which is this Augusta rule. If you've never heard of it, stick around. We go over this in a lot of our courses. there's a whole bunch of different deductions that are kind of sneaky deductions that are available to corporations that are not available to you and me. And it's because when you have an S or a C corp from a tax perspective, so it could be an LLC tax as an S corp, LLC tax as a C corp, you can be an employee, which means you can have an accountable plan. And that sounds like Greek to you. It just means your company can treat you just like if you were working for Boeing or something else. They can reimburse all these expenses and cover these things for you. The company gets to write it off. You don't have to report it as income.
So yeah, if you have an S corporation as a management company, I would say it's highly likely that you're going to have more personal income than if you had a C corp managing your company, your entities.
Fair enough. And then what Jeff said about the C corps is if they do show profit, they're taxed at 21%.
Mm-hmm.
And if they pay that profit out to you, you pay long-term capital gains rates on it. It's called a qualified dividend. So it could be at zero anyway. So everybody always says, oh, double tax. Realistically, it's not so bad a thing anymore since the Tax Cut and Jobs Act came out. It used to be really bad when dividends were ordinary income and the corporate rate could be as high as 39%. You're getting nuked at that point. And that's where most accountants got trained. It's like, oh, they're bad. They didn't actually do the math. When you do the math, it's not that bad anymore. And Jeff also said something really smart, which is you can just pay yourself a salary. Like worst case scenario, you're sitting there on the C corp and you're running. You don't have to work for free. You can pay yourself a salary and get it out. So you're no worse off, So if you're making ordinary income and you'd have paid tax at ordinary income rates here, we can still get it back out to you. Or if you're really scared of that C corp, do an S corp. Quit worrying about it. Don't stress yourself out. Let yourself sleep at night, right?
Right.
Whatever works for you, but it's got to be your decision. We shouldn't just default to your accountant's decision. Anything else on that, sir?
No, like you said, a lot of the old CPAs are stuck on C corps are bad, especially the smaller ones.
C corp bad because they don't want to learn how to use them. No offense to there's probably some CPAs out there that is pissed off. I'm sorry. We learned certain things. Even in lawyering, you learn certain things like, hey, in order to be a C corp, you have to meet all these different tests, and then they do the check the box regs and makes it a moot point. So we all learned under one system, and then the Congress changed it. So I still think that. Somebody says, at any point, does an S corp make more sense than a C corp? Absolutely. When you need to live off the money and you're going to be taking it out anyway, then we can avoid employment taxes on about 2/3 of that money, Horace, if we're taking it out. So there's lots of reasons. Oops, I'll go back to this question. There's lots of reasons why you might do an S corp versus a C corp, and sometimes you do both. Like there's nothing that says I can't have family management company over here, consulting, dental practice, medical, whatever the other business is, construction company, electrical contractor, whatever as an S, real estate. Maybe I'm a realtor. Maybe I'm just have a management company that I'm, doing certain activities, and I have a C corp that's managing stock accounts or something else. Right? I could actually have both. So yes, you can have the best of both worlds, and you can have your cake and eat it too. I'm thinking about cake. Cake. Wait. Darn it. Cake. Right. Sometimes I'm not quick on the draw there. All right. Next question. Can I 1031 a long-term rental, single-family residential depreciation over 27.5 years into a short-term Airbnb and then perform cost segregation analysis on the new property? How does this impact depreciation recapture and depreciation schedules going forward, moving from straight line to accelerated? The goal here is to apply paper losses against W-2 income. Jeffro.
A couple things here. Yes, you can do this. There's a timing issue here that this long-term rental really can't extend into the next year because then you taint your whole short-term rental.
Good point. So a short-term rental, 7 days or less.
Yes.
And you take the total number of people that you rented to, or, what do you call it? Hosted, rented to. It's still short-term rental. But all of our guests, and you take the number of days it was actually rented and divide the number of people into that, and that will give you your average days per unique rental. If it's 7 days or less, it is not passive rental activity. It is a trade or business. You're an electrician, you're a pizza shop, you are what fill in the blank, you're an active business. So what Jeff just said is, hey, if I'm a long-term rental and in the middle of the year I go into an Airbnb, I have to look at the whole year for both those properties.
Yep.
Correct?
So if you're still long-term through January, is it still possible? Yes, but it makes it all that much more difficult to get that 7-day average. Now, depreciation recapture, the nice thing about 1031 is depreciation recapture is also deferred along with all the other gains.
Mm-hmm. So, but what if and what they're talking about is when they do cost segregation, is ordinarily on a property, a long-term rental is 27 and a half years. Airbnb technically is 39 years.
Yep.
And that's called straight line. Hey, I'm just divvying it up over that period of time. When I go in and cost seg a property, I'm walking in there going, hey, that carpeting is 5-year property. Hey, those cabinets are 5-year property. The appliances might be 5 years. That deck outside is 15-year property. Those shrubs and those flowers we planted, that's 15-year. Hey, that new driveway, that's 15-year property. And then I can accelerate that.
Yep.
And like this year in 2023, you can accelerate 80% of whatever that dollar amount is. I can write off right now, the year that I decide to do this, the cost segregation. Now, here's the weird thing. Because you had a long-term rental and you 1031, we have to go back to the year that I believe that one is put into service to determine what's the amount that we would get it for our accelerated depreciation, because that property would be put into service at some point. I believe that's correct, but verify. It's going to be whatever year that property was put in service. I don't think we can sneak around that fact, but it might be 100%. Like if, hey, I've had this property since 2018 and I 1031 it into a new Airbnb, which is a great idea, by the way. Like, you always want the best use of your dollars, and I don't want to incur a tax. Your basis is the amount of the first property. So when you're doing your cost seg, it's still based off of these numbers over here, my depreciable basis minus land, right? You look at just the improvement, the box that you put on that property, plus any improvements.
Now, another issue with this is, let's say I originally purchased this property for $200,000. I've had it for a while. It's now worth the basis is now about $100,000. It doesn't matter if I sold the property for $500,000. The basis in my replacement property is still $100,000.
Yep, it's whatever that was minus the depreciation.
Correct.
Like, you may be better off. Sometimes when you do these numbers, it sounds weird, but if you're going to do accelerated depreciation, you may want to consider just selling it. We'd have to look and see if you have, you might have passive losses that are from other properties or better yet, you might have loss carry forward that you didn't realize get released when you sell. So you may not have a big tax hit anyway, but depending on the value of this property, you may be surprised that you're like, it's actually called a lazy man's 1031. You might be better off selling it and not 1031ing. You may be better off saying, hey, you know what? I want the higher basis and I want to accelerate depreciation. And by the way, we can get those numbers for you before you sell, right? So you could decide, do I want to do a 1031? You could always pull out of the 1031 even after you sell. You still have these requirements. You could just say, nix it, right? Give me the money. Boom, everything's taxable now.
Yeah, because I might be perfectly okay with paying the capital gains on the sale, because by putting that $500,000 towards a new property, I have a lot more depreciation to work with.
And then the last line here, the goal is to apply paper losses against W-2. You're getting a tax benefit if you're doing Airbnb and you materially participate. Material participation, 7 tests. Really only 3 that we pay attention to, which is either you're doing all the activity, hey, I self-manage it, or I have other people working on it that do substantial activities, but I do 100 hours between myself and my spouse. You add both times, and nobody spent more time. No other individual spent more time. So we could, yes. So you, and then the last one is 500 hours between you and a spouse. But on this one, because it's Airbnb, it would be only on your Airbnb property. If you're doing, hey, I want to be a real estate pro, we would actually structure this slightly differently. You'd probably sell the long-term rental you'd get we'd want to lease that new purchase to an S or a C corp or an LLC taxed as an S or a C corp that will be the host so that we can keep it long if we're going to aggregate it with our other rental properties. If you just want to do the Airbnb and you're going to self-manage this and you just want to do it for 1 year or 2 years and you're just trying to unlock the tax benefit, then we wouldn't do that. Again, there's a little bit of convolution here, but people that know this stuff, they'll be able to figure it out lickety split. Like if you looked at us, it would take us 5 minutes to figure out which is the better way.
And another thing Toby reminded me of is if that long-term rental has suspended passive losses under it, I'm probably more likely to sell it because doing a 1031 does not release those passive losses.
And now you're stuck
And
carrying them forward.
right. So I have to keep carrying them forward. But if I sell the property, I can release them, which will go against that W-2 income.
Yeah, and then I see like Dina put in there in a chat, and I saw Patty's responding. You would want to talk to a tax person. I know that there's 1031s that we already know what that rule is. We would just look and say, hey, based on your tax return, what's your loss carry forward? We'll see if they're associated with that property. We'd look at the depreciation schedule, and then we'd look at the target property and see what we could unlock there with the cost seg. We work with Cost Seg Authority. Eric Oliver over there is absolutely aces. We would run through the analysis to see how much we could unlock, and then we could tell you, here's your gain that you would have if you don't 1031. Here's it is if you 1031, which one's better for you, and it'll be looking at your total circumstance. One of our accountants could do that. I would say, I want to talk to a tax advisor. Is it tax analyst or tax advisor?
Tax advisor.
Tax advisor. You say, I want to talk I want to talk to a tax person. You're the CPA. Jeff's a CPA. I'm just a tax attorney. And frankly, some days that's even questionable. All right. What do we got? Another one. Wait. Hey, I hear, oh, gosh darn it. It's not giving me coin. Yeah. There's money out of this. So do the analysis. Do the analysis. I just suck at this. Toby. All right. How do I write off business startup expenses before the business actually starts making any money? LLC costs, education costs, travel expenses for business education, business essentials like phone, office, etc. What say you, Jeffro?
Those expenses are tallied up and they are, there's actually two categories. There's the organization expenses for setting up the entity, and there's startup expenses, and they both have a $5,000 automatic expense line.
Yes. And you have education that would lop into that. So let's go through these. Yep. LLC cost, is that startup or organization?
Organization.
Education cost, is that startup or organization?
That is a startup.
Travel expense for the business education.
Startup.
Business essentials like phone, office, etc.
Startup.
There you go. You can write off up to $5,000 of startup expenses, up to $5,000 of organizational expenses. Boom, immediately. If you go above that, you get to amortize them over 15 years. Ugh. All right. Yeah, over 15 years, you get to write them off. It's like a slow, painful process, but eventually you'll write them off.
Now, if you have substantial education expenses, you're probably going to want a C Corp. That's the only place we can deduct those.
Yes, we want to see what you're doing. We will make sure that we are treating it the best we can. Where can we find a list of write-offs in their category? You talk to Jeff. Now there's I think we have a bunch of different types of expenses, but it depends. It depends on what you're doing. It's just one of those weird things. Like I wish that there was a simple answer. There's not. It's section 162 of the Internal Revenue Code. It's reasonable and necessary for the type of business you're in. Reasonable, customary, and necessary, right?
I guess we could pull Amazon's chart of accounts. And...
Custom, ordinary, reasonable, necessary.
Yes.
Yes. So you're just trying to write things off. You grab a chart of accounts of a big company and look at what they're using. And they all use different charts of accounts, by the way.
And kind of look at it this way. I mean, the definition you gave is this really a business expense? Am I spending money for the business, or did I just feel like I needed a new lawnmower?
Yeah, and get this. So if you have one of these things, a cell phone, it's my wife. Now she's gone. There she is. People are like, what do you got on your phone? It's my beautiful wife. Hi, Sandra. So if I have one of these and I want to write it off and I am a sole proprietor, I'm in a partnership, I can only write off the business expense with this. Who the heck tracks their phone? Like, here's my business phone. Here's my, like, maybe you get a different phone for your business, right? It's just annoying. If I am an employee of an organization, so I have an S Corp or a C Corp, and I work for it, my employer can reimburse me 100% of this.
Yep.
So if I work for Jeff's CPA firm and I'm like, hey, I use this phone to benefit, I do as part of my duties, Jeff could reimburse me 100% of not just the data and the cell, also the phone itself, 100%. And the trick question is, where do I report it? I don't. I don't have to. It's no different than if your employer said, hey, on the way in the office, pick up some pizzas and I'll reimburse you. The employer is going to write off the pizza. When they write you a check or hand you cash to reimburse you, you don't have to put it anywhere. There's no line item on your 1040 that says reimbursed expenses. Doesn't exist. So you're good.
Yeah.
Somebody says you can look at forms on the internet the forms are found on the website. So we have some of those where we have a whole list of different things. So all you have to ask yourself is this the type of expense that would benefit? Like, there's all sorts of things. Meals. Hey, I'm meeting with a prospect. I'm traveling for my business. Hey, I'm going to an event for realtors and I'm a realtor and I'm trying to get continuing education or whatnot. Yeah, that's deductible. Hey, I'm driving around. How about the mileage? Yep, I can write that off. Hey, I spend money on paper and a printer and some computers and I have to get some subscriptions. Yeah, all that's reasonable, ordinary, necessary. Hey, if somebody says the Anderson event, yes, 100% deductible. How about if I go to a golf course? The IRS is going to say, probably not, because that's not where business really takes place, even though it's where business actually takes place.
And they're going to classify it. It used to be you could write off entertainment, no more.
Yeah, they did away with that. Guess who did away with that? Before everybody, like, Tax Cut and Jobs Act. That was the Trump administration. He got rid of the dang golfing and entertainment,
And
except,
he owns golf courses.
yes, like, come on. Self-inflicted wound. All right, let's move on. If we are flipping a home within a 6-month period, can we do accelerated depreciation on top of fixing costs, real estate commissions, closing costs, etc.? Ooh, can you give them what flipping is?
Flipping is when I purchase a property with the intent of fixing it up and selling it to somebody else, which makes it inventory, just like if I bought some apples to sell in my fruit store.
That is 100% correct, which means think about your fruit store. Do you depreciate the apples in your fruit store? No, they're cost of goods sold. So when you buy a house and you're going to sell it, I bought it with the intent to sell it, no matter how long I own it. I was just talking with a former IRS trial attorney on this one, and we were just sitting here chatting, and he's like, nope, 10 years. If the IRS sees that when you bought it, you were intending to sell it, but it was like the market turned or whatever, and you end up making it into your rental for 10 years, that is dealer property. You can't depreciate it. You can't do installment sales. You can't do 1031s. Even if you held it more than a year, it does not matter. You are a car dealership with a car in the lot, but that car is a house. So when you buy a house with the intent to sell it, you don't depreciate it.
But I've held this house for 10 years. What if I'm renting it out on that, even though I intentionally intended to flip it? No.
It doesn't matter. Can't. It's still inventory. That's where there's a number of cases on it. Don't worry. Like, it's out there. You can go. It's not what people expect. And then there's so much bunk information on the internet about it. They're always like, yeah, hold it for a year and a day and you're an investor. No, it's the facts and circumstances surrounding the purchase. If you bought it with the intent to sell it, you're a dealer, even if you hold it for 20 years. If you bought it with the intent to hold it, it's still investment property, even if you hold it for 2 months, because somebody comes in and offers you an outrageous price, which we've seen. So, so if this is you and you're flipping, we're not doing accelerated depreciation. Besides, you would just recapture at ordinary rate anyway as soon as you sold it. So what it is all those expenses get added into your basis. So if I bought a house for $100,000 and I'm going to sell it let's say I sell it for 200,000 and I put $30,000 into it. So I add up all my expenses. I have $100,000 basis. I put $30,000 of improvements. That would give me $70,000 of ordinary income treatment. And I would not do that in your individual name. I'd do that through an S corp or a C corp because it would be subject to self-employment tax. And when I say S or C corp, it could be an LLC tax as an S corp, LLC tax as a C corp. Do not do these in your name because what it does is it causes confusion. If I am the IRS, I need to know what Jeff is doing. If I see Jeff flipping properties, or he's a developer and he develops property, and then he has a property that he holds for 20 years, even if it was clear that that was an investment property, I'm the IRS. What do I think Jeff is?
Dealer.
Yeah. And that's what they do. And the only way they know is they come in and do facts and circumstances. And which means discovery, which means digging into all your documents, which means asking you uncomfortable questions and digging in to see whether they can reclassify that puppy and disallow all the depreciation you took. Disallow. I had a client that bought a property for $4 million, sold it for $7 million under an installment note. The entire $3 million of gain was due year one. The party that they sold it to, this was in 2007, ended up defaulting immediately thereafter. IRS didn't care. They're like, I want it was 700 and some $1,000 of tax. Well, I want that money and I want interest and I want penalties. And they went after him. And at the end of the day, it was a loss for him. He he ended up with the property back. But that took 2 years. And the IRS says, hey, you got to show you're actually trying to recover. You have to show that it's bad debt before you can write it off. All those things, they make you jump through some hoops. Well, it was 2 and 3 year stretch. I think it was over 3 tax years. So they just got bapped and they never even got paid on that sale. So they had a massive tax hit. They ended up with some loss, and thank God, we were able to carry it back at that time. Like there's probably now, I don't think we can carry back.
No, there's no NOL carryback.
Yeah, at that time we could carry back, but it just stinks. It's just, woof. Somebody says, how can I write off losses from, by the way, I can see the chat and I'm always scanning for ones that are relevant to a question that we're asking. So they said, hey, I have losses from a flip. I recently sold a home and took a huge loss, about $20,000 after taking into account rehab, holding costs, realtor commission. How can we absorb the loss in our taxes? Here's the beautiful part. It's an trader business. It's no different than if you ran a pizza shop at a loss. Or I was running, a CPA firm at a loss. It's ordinary loss if you materially participated. So if you were the one doing the flip, you could write it off against your W-2 income, Sonny. So you don't have to worry about it being a capital loss that's restricted.
Yeah, in regards to some of these other expenses he mentions, the real estate taxes, commissions, closing costs, those also are not deductible as you would think they would be.
They're added to basis.
They're added to basis, both front and back end closing costs. Now you will get to recognize them when you actually sell your flip.
But some people, I know you're sitting there going, I'm cash poor. The IRS is asking for money. Why is this? It's because you've been spending it on things that may not be readily deductible right now. It might be something that's going to be in the future. You may not have to pay tax when you sell it, things like that. Something about Supreme Court and tax laws. I don't know. All right, let's keep going. My husband owns and operates an electrical business. When he finishes his job, he provides a statement due upon receipt. So it's an invoice. Please pay me.
I was really trying hard not to say that.
It's an invoice. Come on. If a client does not pay, is it considered a loss? And is it tax deductible?
No, you're on the cash basis, most likely. Even if you're on the accrual basis, it might be a loss, but let's just think of cash basis. You don't recognize any income until you're actually paid that income. Now, I've had people who rent out their cabins to churches and all for things, and they want to write off the loss of income from those. It's like, no, you can write off your normal expenses, all the expenses he did put into that job, he can write off, but you can't write off a loss for money you never got to start with.
Yeah, as a cash basis, Jeff just hit it on the head. As a cash basis taxpayer, you recognize income when you receive it. you don't get a loss unless it's actually something that cost you. Like there has to be a deduction. Well, not paying just means I don't recognize the income. So I'm at zero. If it costs me money to do the job, so if it's electrical business and it cost your husband, you know, gas to get over there, some employees to work on things, the materials, hey, I did some wiring and some, and I had some caps and I had this, that, and the other, maybe I have 300 bucks of cost, and maybe it was $1,000 invoice.
Yep.
You would get the $300, your expenses. You could use those as losses and write it off against your other income. But I never received the $1,000. So just because they didn't pay me doesn't mean I get a tax deduction. I just don't have to recognize it as income.
And we hear that pretty often, that people want to write off their lost time for working on stuff they were never paid for. And IRS is going to tell you that's not a thing.
Mm-hmm. It's tough.
Yeah.
And we get that all the time. And people do this again, like, hey, I donated my time to a charity. Do I get to write it off? No, you can write off your expenses. I think it's like 14 cents a mile or something. Like they have
I was gonna say your
reduced
mileage.
amounts, but if you like you did postage or something, hey, I took a whole bunch of envelopes to mail out to for my church and I spent 30 bucks on postage. You can write off the postage, but I can't write off the time that I spent on it because you never got paid for it. Now, if you got paid for it, then you don't have losses, obviously. So hope that helps. I know it sucks, and that's why it really hurts when people don't pay their invoices. Now, if you're an accrual-based taxpayer, this could be a slightly different story. You would have the income accrued when he sends the invoice.
Correct.
But then they didn't pay it, so you'd have to write it off as uncollectible invoice, and you write it off. You're still at zero. Like you're not worse off, better off. You're still at zero. Is that good?
No, that was exactly right.
Phew. It's like a broken clock.
You're right, twice a day.
Twice a day. That's about it. Depends on the clock too. Like, all right, we got another one. Because we love answering questions here. And by the way, really good questions. I'm going to just say, where's Elliot? Elliot, good job today. Like we really like your questions. At least I do. Do you like your questions?
I like your question.
All right, so Elliot, you can do it again. Nobody wants to pick the questions. There's like 400 questions you guys send in every 2 weeks.
And he's been really good about not giving them just this question.
There was a time when we would have 2-page questions. We had to have a chat. No 2-page questions. Like, and I'm probably I had to talk to myself. I was probably the worst offender. I'd be like, wow, this is a really good one. It's like 6 pages. All right. Please discuss the pros and cons of borrowing from my life insurance policy to purchase real estate. Is any part of the interest I would pay on this loan tax deductible? Jeff.
I'm going to give you the second part. The interest is certainly deductible on the property you're purchasing. May not be much if it's an insurance loan, but
here's the thing. It's like, what's the pros? I have access to a policy. Usually it's whole life or indexed universal life, variable universal life. Different policies have different ways of treating the loan. Some call it a wash. Hey, you don't make money on the money that's in the account, but you don't pay interest either. Like it's a zero.
Mm-hmm.
So you're like, okay, no harm, no foul. I'm just not making money on it, but I'm not paying interest. They'd still probably assess you an interest, so you could write that off. But then there's income of that same amount in the policy, which puts you at a zero, but you'd still get a deduction. Some of them, it's, hey, this is the rate that we're going to use. It might be something like I know LIBOR's not around anymore, but it might be a LIBOR plus or prime plus 1% or whatever it is, right? Or it's, here's a baseline that we use, some calculation that they use for the interest rate. So maybe you're paying 5% interest. You could be making 20% on the money in that policy, unless it's whole life. Like, did they say this is just life? They didn't say. So let's say it's whole life. You're probably making 6 or 7%. And maybe they're charging you 5% of the policy. So you're still making money and you're getting to write that off. This is really important. If I do a HELOC, if I borrow against my insurance, if I borrow from a related entity, that money, the interest that I am paying is investment interest expense. It's going on my Schedule E, and it is going to be deductible against my rental income. So I'm still going to be writing it off. So it's absolutely 100% deductible to you. I don't see a lot of cons on borrowing from my life insurance policy.
I have one thing, and it's not really a con, but it's what I've seen as a common misconception of, if I default on my HELOC or my bank loan or something, that's going to generate income to me.
Mhm.
If I default on my life insurance loan,
It's already secured, and it's not secured by the real estate. There's the thing. I borrow against my life insurance. It's not secured with the investment property I bought. It's secured by
your
my
life.
life. All
Yeah.
I got to do is die someday. Hopefully I can do that part right, right? Like, oh, I couldn't do anything right. The only thing I could do right was die and pay off my policy. That's great, right? The death benefit is going to pay that back, and it's not taxable. So it's actually really a good thing
Yeah.
to borrow against. Again, I don't care whether it's a HELOC. I'm going to write off the investment expense on my Schedule E, even though you might be thinking, hey, no, I have to write off my mortgage interest on my Schedule A. That's only your personal mortgage. That's on your personal residence that was used for acquisition indebtedness when you bought it or fixed it up. Here you're taking money, you're securing it with your home, and you're investing in something else. I can write that interest off as investment expense. People don't always realize that, and they leave some money on the table. We want to make sure you do not leave that money on the table because it's ka-ching, ka-ching, ka-ching. We want to make sure, yeah, money.
And something Elliot and I were talking about on this very subject is, you take a line of equity on your home to buy another property.
Mhm.
The interest you pay on that doesn't go on your Schedule A, it goes on that property.
Yeah, it goes on your Schedule E for that property, which is money in your pocket. I don't know why more people don't do that. You can do it against a security-backed line of credit. You can
Yeah.
have a stock account, and you go there, and they'll oftentimes loan you up to, I always say don't go over 50%, but they'll loan you for 70, 80% on some of these, up to 90%, depending on what it is. And it's at a lower rate than you would get if you went to a real estate lender. And it's like, why aren't you taking the money that is available to you right here? Or you could borrow against your 401k. Or go find a friend's IRA where they're self-directed, and they let them stake you and pay interest. At the end of the day, it's not the source that matters.
Correct.
It's what it's used for. And if you're using it for rental real estate, you're going to be using that interest and deducting it against, you're going to be using it as a deduction regardless. Very exciting. Anything else on that one?
Nope.
Woo! All right, let's get this one. How do I offset passive loss? As soon as I see passive losses, I'm like, all right, somebody knows what they're talking about. How do I offset passive losses other than increasing rents and paying off debt? Do I partner with someone who's generating a lot of passive income, buy a property that has generated a ton of income for the year? What can I do before the end of the year so I can use this year's taxes?
All right, going to that very last question is kind of the key. At this time in the year, there is very little you can do. If I go in and buy into Toby's partnership, who has a ton of passive income, I only get that portion from now until the end of the year, not
Yep.
what he's earned previously.
Ooh, right. You're looking around for passive income from your other sources. So if I have passive losses and I'm like, shoot, yeah, increase your rents to market rents if that's what, if you're doing under market. Yes, go find businesses that create passive income that I can offset. So I always use the pizza shop, Toby's Pizza Shop. Jeff has passive losses and he needs some passive income. He could partner as a silent partner who does not materially participate in my pizza shop. And when I pay him, let's say we make $100,000 a year, we split it 50-50, he gets $50,000. He may not be paying any tax on that because he has passive losses from his rental properties. Me, I'm working in the pizza shop. I'm going to have active ordinary income, so it sucks. I don't get to do the same thing. But there's two types of passive income and passive losses. There's two types of income sources. There's businesses in which you do not materially participate, and rental income, and not just any rental income, long-term rental income, which is more than 7 days, right?
Now, there is one other thing you can do before the end of the year, and that is sell one of your businesses or properties that has all this passive loss.
Well, he has passive losses, right? So he'd have to sell it with passive gain.
Well, yes. Well, the passive losses though would be freed up upon
Oh, if he has passive losses on a property
Yes,
and you said, geez, we're not getting to use it, you could sell that property
correct.
and it would release that passive loss to be used against that property's gain and then carry it over and use it on other.
Correct. And going back to what you were just saying was
Mhm.
if he has a gain on that property, that's also passive, and he can apply that against
Yeah, he has other
any
passive
any other
losses.
passive losses. Yeah.
Yeah, so sometimes we're playing a game. We're looking at things and say which one has loss, which has a gain. Is there a tax reason to do something? Maybe. But then here's the last thing I'll say on this. If you have excess passive losses, they don't go away. You don't lose them.
No.
So it's not like you're on a timeline like, oh shoot, I need to get some passive income or I lose it. You just carry it forward into future years. We'll still use it. Hey, if you like this stuff, guys, I know I already mentioned this, but we got a 4-day live event here. We're going to do another one. I think it's in March. I
Nice.
think we're looking in Texas to do a live 4-day event. 4 days of having to hang out with lawyers and investors and real estate investors and stock market people. 4-day event here in Vegas, starting on Thursday, Friday, Saturday, Sunday. I'm speaking on Thursday, probably on Saturday, probably on Sunday. It'll be a lot of fun. Who all's going? Hey guys, give me a thumbs up if you're going to this event. Some of you guys might be some. Yes, there we go. We got some people in the chat, but give me a thumbs up. There's a few folks, like 2 thumbs. There we go. There's some more. All right, so there's a few more. All right, so a bunch of you guys are coming. Come hang out with us in Vegas. Actually, there's a whole bunch. There we go. And then come to hang out with us next year. But we also have the free 1-day events. I just had Brent Nagy, who's a really cool client for a long time. He's a real estate investor, and he did Clint's portion
Really?
on last Thursday. He did a very good job. He's a pilot, a very successful real estate investor, and he's really wanted to talk on this because he said it's had such a big impact on his business. He says, I'd like to teach it. So we're like, okay, come on out, hang out with us.
It is a lot of fun, and you learn a lot of important stuff.
Yeah, you learn about land trusts, LLCs, corporations, Wyoming statutory trust, living trust, personal residence trust, uh, all the different types of tax treatments, S corp versus sole proprietor, depreciation, accelerated depreciation, cost segregation. We're hitting a lot of different topics. Then we go into legacy planning. What is a living trust? How is it used? What are your options? 3 options that you have, 4 different ways that you can distribute an estate. There's a lot of stuff that we go over in that one day. It's pretty action packed and sometimes it goes slightly over, but for the most part, it's a 9 to 4 type endeavor. Take a day, learn a lot of good stuff. All right. I am a licensed contractor working full time in my 100% owned construction company. I am a salaried employee, so I do not have a punch card to track my worked hours. Am I a real estate professional for tax purposes?
Uh, so I'm assuming it's a C or S corporation. And since you're
Looks like
100% owner, this does not make you a real estate professional, but it goes towards what we call the first test of being a real estate professional, meaning you had 750 or more hours in a real estate business.
Yeah, so it's 469 of the code, and it's where they did the passive losses. So they said, and this is actually like 1986, they were sick of tax shelters. And so they basically
Oh, yeah,
said,
yeah, you're right.
we're going to create this new category called passive income. Passive losses, paper losses, can only be used against passive income unless you're a real estate professional, unless you're an active participant in real estate making under 100,000, and then it's 25,000. So they carved off some exceptions. The reason they did the exception is because the year following this new law, construction owners said this is not fair. Developers said this is not fair. We need those losses because we get treated like crap because we have inventory instead of depreciable assets. So when we are buying our houses, we need losses to not be passive. We need them to be ordinary losses that I can use to offset the income in my business because I'm treated so unfairly under the tax code. And they won. They actually said yes, and they changed the law to basically create those exceptions, the real estate professionals and the active participant. Active participant's the easiest one to qualify for, but it phases out between 100,000 and 150,000. So if you're somebody who makes less than 150,000, there's a good chance you don't have to be a real estate professional to write off a bunch of your losses. If, you know, you could be writing off up to $25,000 in a year just for hiring your own manager. That's what it is. Are you ultimately in control of that property? You're an active participant. Real estate professional, there's two big tests. And Jeff just said prong one, prong two. Prong one is I work in the realm of real estate trades or businesses. I spend 750 hours a year at least in those businesses, and it's more than 50% of my personal service time. If it's a joint, married filing joint, so it's a joint taxpayer, one spouse has to qualify. Here we have a licensed contractor. They own their own business. The threshold is you have to own at least 5% of that business for the time to count. So under this one, if he's working full-time, he just has to have some reasonable tracking. It might say, I worked full-time. This is the only time, this is my only business. The IRS would probably buy that if they could see, keep some sort of calendar, like, hey, I work 40 hours a week. You don't have to have a punch clock, but you have to have something that shows this is what I was doing. Like you could be looking at all the jobs, you could be looking at the income. Best thing to do is to put it in a calendar so that you don't even have that issue. But if you hit the 750 hours and it's more than 50%, so long as in this construction company you're working full time, you don't have another job, you're going to be more than 50%.
Yep.
Then we go to test number two. Test number two is, did I materially participate on my rental properties? And in that case, what do we usually do? We aggregate them.
We aggregate them. If you have more than one property, you really need to aggregate them.
Which means we treat them as one activity. And then the material participation test, again, there's 7 of them. See if I can actually do 7. And you're going to have to qualify under one of those. The 3 that we pay attention to is you're the only one doing the work, substantially doing all the activities, which is possible to do if you have a property manager. Prong number 2 is you and a spouse do over 100 hours together, and nobody else spends more than 100 hours on your properties. Prong number 3 is, and you just have to meet one of them, is 500 hours or more. So like you could qualify together. So if you're a real estate contractor and you're working on your properties, you would actually track that time. And I understand you're not doing a punch card, but you'd want to track that time because if the IRS comes in, they're going to want to know, all right, did you meet the material participation test? You could use it the time that you work on your properties towards that test. Otherwise, we're really looking at you and your spouse and what did you actually do on your rental properties?
Yeah, payroll records might suffice, but I would want to have that number of hours worked in there, even if it says 40 hours every week.
We just don't see a lot of challenges on this because they know the accountants. I should say we don't see it probably because it's all of our returns are professional taxpayer prepared. Have you ever seen one like this last year? Did you see any?
I didn't see any. No.
We do over 10,000 returns a year, and we didn't see any. Like they're not really looking at the real estate professionals if there's an accountant, because the accountant is the one who's certifying it, signing it, and all that good stuff. They're kind of deferring. What they're really going to do is look at the person who's probably taken a big old loss. They know that person has W-2 income. It looks like they have another job. There's no way they're spending more than 50% of their time on real estate trades or businesses. They're just writing it off. But 20-something years we've been doing this, Jeff, for about 50. Just kidding.
Jeff, one of the difficulties I've seen is 2 unrelated, non-married people will be in a partnership, and they will both want to be real estate professional, and we have to explain to them, well, you both have to meet the 500-hour requirement for you both be real estate professional.
Yep.
Which becomes a little more difficult.
Remember prong 1, active businesses, development, redevelopment, construction, real estate agent, all that stuff. It doesn't have to be anything to do with your properties.
Right.
You have to be in the real estate trade or business 750 hours, more than 50% of your time. And it doesn't have to be the same. Like this person could be doing a construction company, be a real estate agent, and be a developer. And they spend 300 hours on each, and you add them up, it's 900 hours. Great, you qualify. But then you have to materially participate on your rental properties. And it's per property unless you decide to treat them as one activity called aggregation. So you have to aggregate your properties. The court cases that I've seen that are against taxpayers, almost always because somebody didn't aggregate, and then the tax judge has to follow the law, and they're looking at it's going, it's per property. You chose not to aggregate. And then they yell at their accountant. The accountant had no idea that was even an issue. It's not their fault. There's like, let's just be real. The number of accountants that do real estate returns is very, very low. Very, very low. All right. Next question. Can I create a 401k for my real estate investment business? Does it cause a problem if my salary job provides me with a 401k?
Not at all. I mean, you can certainly start a 401k in your business. The amount you personally can contribute is still limited to what it was for your 401k with your employer. So if you do 10,000 here,
The employee deferral portion.
the employee deferral, you can't do 10,000 in your business and 30,000 in the other business.
And what that is there's the employer can contribute up to 25% of your salary. They can always do that. You can have 10 401ks with different employers, but they're limited in what they can contribute up to 25%. And then each plan has a limit of 66,000, or if you're over 50, then there's a makeup, I think it's 7,500. The employee can contribute up to 23,500 or whatever it is in the particular year. 23,000, or is it 22,500? Is it 22,500?
I know the total's $30,000
Yes,
for
20
catch up.
Yeah, so I think it's 22,500. But you can contribute that. The employee can put that into their employee side, and that is not per plan. That is for the employee. So if I put $20,000 in this employer's plan, and then I put 20 in over here, I've over contributed, right? I can only put in up to 22,500 plus any other amounts, but the employers can contribute to each plan up to the 66,000.
And what plan A, the employer contributes, has nothing to do with what plan B.
Yeah, but then I want to touch on one other thing. It says 401k for my real estate investment business. Depending on what type of business you have, in order to contribute to a 401k, you have to have active business. It can't be passive. So if you have rents and you make $10,000 a year in rents, you can't contribute that into a 401k. That's passive income. It needs to be ordinary income, active ordinary income. There is a way to turn that in. You need a management corporation. That's why you use an S or a C corp or a LLC, tax as an S or a C corp, and manage your properties. Then you could put that money into the 401k. Just remember that 401ks, they're deductible for federal income taxes and state income taxes, but not for employment taxes. So no matter what, you're going to be paying old age, disability, and survivors and Medicare.
So actually, there is time if you have an active trader business that has substantial cash, you could and should pay yourself a substantial salary now. You have until 2024, sometime in 2024, to set up your 401k and make that employer contribution.
Yeah, so the employer contribution, since I think it was the Tax Cut and Jobs Act, or was it the Secure Act that gave us the
it's the Secure Act.
So they basically said, hey, the employer can set it up and contribute all the way up until they file their tax return plus extensions. So if you work for an S corp, for example, it could be next, September 15th, and they could make the contribution of 25% of your salary in there. So it's like, yeah, the employer could still do that. You can still do a defined benefit plan if you want to really ramp it up. I've had clients this last year that were putting in $70,000, $80,000 towards the filing deadline because they wanted to lower their tax bill for the previous year. Yes, you could do those things. There's all sorts of little tricks to those. But to answer this question is, can I create a 401k for my real estate business? Yes. Even if you can't contribute to it, you could roll over your IRAs and do other things. But if you want to contribute to it, you need to have active ordinary income. It does not cause a problem with your salary job, with the exclusion of you have one amount that you can max that you could hit for the year as an employee, putting portions into your employee contribution plans. So you just can't exceed that. So Jeff could go up to 30,000. I go up to 30,000. You're under 50. You're up to 22.5. I think that's what it is. So you look at whatever the year is, use that number.
Wait, how do you know I could go up to 30?
Because you old. All right. Here's I think it's the last one.
Yep.
So here's the last question. Is there an age limit for your for hiring our kids? Is there an age limit for hiring our kids to work in our family business? Question mark. We have a 6-year-old and a 13-year-old. Oh my God. 6-year-old kids working. What is this? A work camp? Yeah, anyway. Can we do that?
No, I wouldn't hire the 13-year-old. That's when they start getting a little mouthy and
Put them to work. Just don't pay
yes,
'em.
you can absolutely do that. However, you have to have tasks assigned to them that they're doing. You have to be paying them for something. So you can't just say, oh yeah, my 6-year-old is on my payroll, even though he's been in school the whole time. And sweeping the floor, we talk about modeling for the cute little ones.
There's a court case with the IRS where it was a 9-year-old, and the question was, what's a reasonable amount that they could be compensated? And it was whatever, in that case, it was Screen Actor Guild. It
Mm,
was modeling and being an actor for marketing. And yeah, it's not like they look at it and say, oh, you're a 6-year-old, you can't get paid. What they always say is, what's the task you're doing and what is the marketplace for it? And then before you say, well, the Department of Labor is going to come crack down on me. No, the labor laws is 14 and 16 years, plus states have different ones. But that's not the case when it's your child. So if it's the parent-owned business, then you can put these kids to work early. If they're under 18, you don't have to withhold employee taxes. So if this is a uh, sole proprietorship, disregarded LLC, if this is a real estate business partnership,
partnership, yeah.
and you are paying them, then you do not have to do old age disability and survivors of Medicare. And it gets better if you pay them less than whatever the standard deduction is. So this year it's 13,850. They pay zero tax. They don't have to file a tax return. They can put a good chunk of that. Let's say they want to put, I forget what the limit is this year in IRAs, but like 6,500, I think. I can put that amount of money into a Roth IRA. I never paid tax on it, and I'll never pay tax again on its growth or any of the income that comes out of that. So you could set your kids up. Just think about the 6-year-old. Let's say they were able to do $5,000 worth of work. That's $5,000 that goes into a Roth IRA. I don't know. I don't even know how many times that would compound before they hit retirement age, but they're going to be very well off if you put that just in SPY or some index fund. 13-year-old, same thing. They have so long. Like, just think about it. They retire at 70. So you have what, 57 years of compounding before they even touch the money.
$1 billion.
Yeah. So he says, I own a construction company. My son is 11 and flies the company drone to get updated aerial photos every week of the projects. How much can I pay him? I'd call up a professional drone company, usually photographers. They do the drones and figure out how much they would charge.
See, I'd call Delta and see how much they're paying their pilots.
Yeah, no, that's horrible, Jeff. No, 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 that's it. No, no, no. Right now, don't listen to Jeff. What you do is you go and you find, hey, what is the cost of getting something comparable? If your kids are over 18, or if it's parents or siblings that you want to put to work, it's still like if you're covering their expense, you don't get any deduction. If I can move that money to their tax bracket, quite often I'm saving a substantial amount of money. You just have employment taxes, but it counts towards their quarters to where they get actually benefit. So they may be getting that back at some point, assuming that there's still Social Security when they retire.
And what you're talking about with the drone is perfect
Mm-hmm.
for a situation like this.
Isn't that fun? Like, again, I always just think of the parents that are working their butts off. Here's a 6 and a 13-year-old, and you're like, I'm saving up for college and all this stuff, or whatever it is. Trade school, go to Tyler Sassy and go to welding school. But if that's on my YouTube channel, I'll show you that in a second. But let's just say that you're saving up and you're like, hey, I'm really worried about these guys. I want to make sure that they are set. Instead of you paying for something, like if Jeff pays for it, after it comes out of his bracket, if he's paying $10,000 for a kid to go to school, it's probably costing him closer to 15,000.
Mhm.
after employment taxes and his tax bracket to make the $10,000. Like you, again, we earn money, we pay tax, we spend what's left. If we can get it to a kid who's that tax is zero, you make 10,000, you spend 10,000, you're great. Even better yet is, hey, I'm okay to take a little bit of a tax hit on my money. I want that deduction though, and I'm going to put it aside for their well-being. And then think about this. Let's say that you're putting it aside because you want them to go to college or because you want to get them into real estate investing. You want them to have a nice amount that's sitting there. You do this over the years. You make, let's say it's $5,000 a year, and you do this for the 6-year-old, and they're making 5,000 bucks a year, and they're doing that for what, 12 years? You got 60 grand sitting in there plus all the compounding. So maybe it's 100 because that's over a long period of time. If they need to get the 60 back out, it's tax free. They can always take the amount that you put in and they can take it out and use it if they need to. You can't loan it out in an IRA, but you certainly can take out those. So if there's an emergency or if they're going to go to school or whatnot, the amount that it's grown stays in there. Just leave it. But the amount that they put in, they can take that back out and then let the rest of it ride. There's so much more flexibility here than those 529 plans and all that other
Well,
stuff there.
I was going to say something about that because before I wouldn't have said this, but now you put in 6,500 into that Roth IRA, you still got 6,500 left. I would be tossing that into the 529 plan because now those 529 plans can be converted later into Roth IRAs.
Oh yeah, so you could do it.
So you're still building up, you still have that tax-free
I still like
gain.
Roth.
Oh, I wouldn't, for these guys, I would
Yeah.
definitely be putting it in the Roth.
That's what I would be doing. And yes, you can hire your 6 and 13-year-old. So the answer to this question is there an
Yes.
age limit? No. If it's under 18, there's no employment taxes. Over 18, there's employment taxes, but you still can pay something to anybody who's working. And by the way, you could do this with a nonprofit too. I push people towards these things quite often because I like it as a family legacy. You got something that you're doing that you really care about. Maybe it's housing, affordable housing, veterans housing, recovery housing, women housing, this, that, just fill in the blank. If it's doing, even Section 8 housing qualifies as nonprofit. It's out of your estate. Nobody can take it from you. So if you get sued by, a ton of people, they still can't take it, but it doesn't get probated. Something happens to you, your kids work for it. They don't take that money and buy a Ferrari. They actually have to work and they make a nice salary, but they're working on something that you created. It's a nice legacy tool. I just like those. If you like this type of information, I'm going to throw this back out at you. Boom, there's the YouTube channel. I mentioned Tyler Sassy. If you guys weren't on in the very beginning, let's talk about Tyler because he's really cool. He has a welding school. Came on, we did a nice interview. Go check it out because if you know anybody who's thinking about going to college and paying $200,000 for basket weaving 101, this might be a better thing for them. There's all sorts of tools where they don't even, it's not even going to come out of their pocket. There's other groups. So it takes about 6 months to get their certification. And right now we need lots. I think it was $15,000, $20,000 shy. It's a huge amount of people that were short in the trades. They're making good money, and he's a good dude. So again, we all know somebody that might be better off going in and doing some welding rather than jump in and do the basket weaving thing, or just maybe they just don't know what they're going to do. But if you like tax strategies, different types of ways to make money, by all means, jump in there. It's absolutely free. Subscribe, like it, all that stuff. Good stuff. I think there's over 800 videos or something like that. No, over 700 videos. Sorry, there's over 700 videos sitting in my YouTube channel. With a lot of them are questions and answers from these types of Tax Tuesdays. And then I already mentioned this a million times. I'll just say it one last time. Join us for a tax and AP event. They're free, 1-day events. And then the ones that you actually pay for are our live events. They're 4 days. They're less than $1,000. And I think substantially less. We're always doing different types of deals. So be on the lookout for those. You can come in and learn how to make money on day one, learn how to keep it on day 2, 3, 4. And it's really, really fun because you're around a bunch of investors and you get to hang out with us and Jeff and me, maybe me. You gonna come to one?
I hadn't planned on it, but I may have to stop down there.
It's just, he'll be sleeping in. No, if you have questions in the meantime, because we do these every other week, email Tax Tuesday at Anderson Advisors. We answer your questions. We also pull the questions that we use during these events out of that. And if anything else, just go check out Anderson Advisors. We put these on not because we're trying to get anything, but because we think it's really important to educate people on taxes because there's a lot of bad information and there's a lot of bad folks out there. You don't have to pay tax. Yeah, all right. Let's not get everybody in trouble. There's a legal way to do things right. You're probably seeing that there's a lot of loopholes, if whatever you want to call them. There's laws written to incentivize certain behavior, and there's incentives given to people like people that make dividends, people that do real estate, and there's lots of different ways to get great results out of your tax planning if you spend a little bit of time learning about them. So that's what we do. Is we're just like, hey, can we teach this? Will people listen? And if they will, we'll keep teaching it. And we have hundreds of people that come on every other Tuesday, plus thousands of people that watch the videos. I mean, tens of thousands at this point that are grabbing this information. I just don't feel like we have to charge for it. I think it's a great thing if people are just getting smarter. And that's it. Jeffro, anything?
No.
All
I think
right.
you got it covered.
Then guys, we'll see you in 2 weeks.